Did you know that the Great Depression wasn't just a sudden accident, but the final snap of a system stretched too far? That it didn't begin with panic in the streets, but with confidence, optimism, and a belief that Wall Street had finally cracked the code to endless wealth. Millions trusted the system with their savings, their futures, their children's inheritance, and then almost overnight, it vanished. The real mystery isn't that the crash happened. It's why so many people never saw it coming. To understand how generational wealth was erased, we need to rewind to the 1920s, an era known as the Roaring Twenties. America had emerged from World War I as a global industrial powerhouse. Factories were booming, consumer goods were everywhere, and the stock market looked like a money-printing machine. New financial tools promised ordinary people access to elite wealth-building opportunities. Bankers, brokers, and politicians all said the same thing: this time is different. But beneath the surface, the system was quietly becoming fragile. The roots of the Great Depression were planted years before the crash. Stocks could be bought on margin, meaning investors only paid a fraction up front and borrowed the rest. As prices rose, confidence exploded. More people borrowed, more banks lent. But this growth wasn't driven by real productivity, it was driven by speculation. Meanwhile, wages stagnated, farmers were drowning in debt, and wealth was increasingly concentrated at the top. The economy looked strong, but it was hollow underneath. By the late 1920s, Wall Street was untouchable, at least on paper. Newspapers celebrated teenage stock prodigies. Shoeshiners gave investment tips. The market kept rising because people believed it would. But belief is not value. Companies were wildly overvalued, and debt quietly stacked higher each month. The higher the market climbed, the more damage a fall would cause. In October 1929, the illusion cracked. A wave of selling triggered panic. Margin calls forced investors to sell at any price. Banks, heavily invested in the market, collapsed. Savings evaporated. In days, decades of accumulated wealth disappeared. This wasn't just a market crash, it was a systemic failure that turned fear into freefall. The consequences were devastating. By 1933, unemployment reached nearly 25%. 1 in 3 banks failed. Families lost homes, farms, and life savings. Wealth wasn't just reduced, it was reset. Entire generations lost the chance to pass anything down. And those who survived learned a painful lesson. When financial systems fail, trust is the first casualty. Government responses came late and often missed the mark. Early austerity measures worsened the downturn. It wasn't until massive intervention bank regulations, public works, and social safety nets that recovery began. Even then, it took years. The damage to generational wealth was permanent. Here's the unsettling part. Many of the same patterns exist today. High household debt, asset bubbles, financial products most people don't fully understand. In 2008, global markets lost over $30 trillion, and wealth inequality widened again. The system didn't collapse, but the warning signs were familiar. The Great Depression wasn't just history, it was a warning. And the question isn't whether markets will fall again, but whether we'll recognize the pattern in time. This is Nito D Creator. Follow for more.